Well, good afternoon, everyone, and thank you for joining us today for this panel on capital formation. I'm delighted to be here with co-moderators John and Emma, and two of, in my mind, some of the most thoughtful investors in the space, and Chris and Arjun. So for today's discussion, I thought we would talk about the state of the capital markets, what's importantly different this year from years past, the macro and the micro influences that are factoring into capital raising, and then importantly our outlook on the next few months into the end of the year and beyond. So to set the stage, I thought we would start off with Chris and Arjun, both looking at the space from slightly different perspectives. Chris from the early stage perspective and Arjun from the mid to late stage market perspective. If you could provide a little bit of color on what you're seeing different today, importantly, versus the last 2 years. Chris?
Yeah, so I manage the venture funds for Perceptive Advisors, which is a multi-stage investor. They're most well known for their hedge fund, public equity crossover fund. But I think there needs to be an appreciation that the venture early stage investing markets are very linked to public equity investing and valuations and the IPO window. When you're trying to value early stage companies, it's more art than science, right? Because they're early stage, it takes a lot of capital, many, many years away from potential for revenue generating. So we often look to public market valuations to guide how we value, how much investment we can put into a company. Could that attract public equity investors to take a company IPO? So we rely a lot on comparables. And so when the markets are good and those valuations are high, it makes it much easier to open up the checkbooks and invest in early stage. When that IPO window is open and those valuations are high, we've experienced the last few years where it's been very difficult to take a company public. The valuations have come down. We still have many companies trading at or below cash. And so that makes it more difficult, and we need to be more discerning, and we're more sensitive to pre-money values in the early stages. And so the last few years in some ways have been good in that it's allowed us to be more disciplined, more discerning. We're not quick to invest in new companies in seed and Series A, and we're more likely to tend to our current portfolio to make sure that the things that are working gets the level of private investment that's needed. I think we're sitting here optimistic that with interest rates coming down, we know that will result in inflows, particularly into higher risk categories like tech, biotech, and we think that the market's ready for investing in biotech again, let's say 2025 post-election. So we're starting to be more willing to invest in early stage companies. Now, the interesting thing is that in venture investing, you want to be patient, right? Venture investors know it takes a while to exit, and it's in the bull markets where that kind of gets thrown a wrench in it, and people think it's easy to go public. You can go public with preclinical data. I think we're in an environment where you need data. You need to be convincing that this company is worthy of going public. But that's what I would say about early stage.
Yeah, firstly, Arjun Goyal, I'm one of the co-founders and managing directors at Vita Ventures. We're a stage agnostic therapeutics focused fund. About 80% of what we do is on the private side, and the rest is on the public side. I think Chris has laid out sort of the precepts of investing in the private markets in biotech in terms of what we look for. Overlaying the mid to late stage market, compare and contrast 2019, 2021, the COVID bubble. Chris mentioned, and I would reaffirm, many companies could go public on a story, on a narrative, particularly in modalities that offered a lot of potential for curative treatments, whether that's mRNA, whether it's cell and gene therapy. Historically, not backed by a lot of data up until that point in time. And you saw specialist investors on the biotech side and even generalist investors participate both on the crossover and public market and follow-on financings. And that was really the market. It was a strong sentiment for biotech on the macro side. And then, a golden age in terms of scientific innovation. Fast forward to today, the environment is very different. I would still say it's a very strong period for scientific innovation. And we can discuss what that, what that means. But it's really around data and medical products, de-risked targets clinically, fast follower approaches in areas like immunology, oncology, large markets, so $3 to $5 billion markets for pharma. And what I would also say is a stock pickers market. So, over the last several years, you've seen a tripling, if not quadrupling, of biotech companies on the private and public side. There's a lot of good companies there, a lot of companies that will ultimately develop products successfully, will get acquired, which is the lifeblood of liquidity in the market. And you do see a number of late-stage investors and even public investors really underwriting, phase 2B proof of concepts and then M&A for a number of these companies. And so that market is actually very, very robust. What's changed is the sentiment to platform companies, early stage companies, and a greater deference for actual, I would say preclinical data that offers, a best-in-class or first-in-class approach, or clinical proof of concept data as a linchpin for a follow-on financing or for an IPO.
Great, thank you both. One of the other topics we thought would be interesting in this setting would be to discuss how you are working with strategics in this environment. So when are you engaging with strategics today? And what does a really good strategic relationship look in your mind when you're working a venture capitalist alongside a strategic investor?
Yeah, absolutely. So I would offer, two sort of grounding principles, at least how at Vita we think of strategics. So strategics, pharma companies, they're a very important collaborator, both in terms of equity investments in private companies, early stage or mid stage companies. So that's the first bucket. And then they're an important collaborator in terms of partnering around programs or platforms, right through the spectrum of preclinical to clinical development. That's kind of the second bucket, and that partnering could be a licensing deal, a COCO, or M&A at the right time. And so we actually embrace, corporate venture capital or direct equity investments from strategics when we put our companies together. For two reasons. The first is that it helps defray some of the financing risk in the early stage. And oftentimes when we put together a round, we're thinking of, funding to a value inflecting data point. Often that is a clinical data point. So we're really looking to raise, 2.5, 3.5 years of runway. So corporate venture capital from that perspective is an important addition to traditional, early stage or mid stage investor capital. That's the first bucket. Second bucket is, many corporate venture groups have evolved their model such that they can offer a very important perspective to the portfolio company, to the company around R&D, around what's a good target, around how to run the study in the right way, and we have found that to be helpful. There's still ways, considerations to be important that one should consider in regard to how many corporates do you have. What information flows do they get around, partnerships? But these are, tactics. The overall philosophy is that they offer a very important, addendum of capital and equity capital in the early to mid stage, and also a validation as you think about deal making.
Yeah, I would say, when we were in the hyper bull market that ended in 2021, I think it changed from being a seller's market, meaning if you were a small biotech, it was easy to get capital. Whether you were private or public, valuations were high, it was easy to raise money to continue to move forward independently. Well, when that changed, all of these biotechs, and the majority of biotechs out there, were struggling to get their next private round, or they couldn't raise money without significant dilution because they were trading at or below cash. And so when you have those types of environments, actually pharma and big biotech, they're excited because now those biotechs are open to partnership and to giving away rights in order to stay alive and to advance the program. So, so that's one aspect that we've seen more of an openness of most of the biotechs willing to talk to strategic partners for some type of collaboration, non-dilutive capital to continue to advance the program. On the other side, M&A remains pretty steady state, year over year, regardless of the IPO window or how bullish the biotech markets might be. And for that, you really, for the most part, have to generate clinical data where that strategic partner says this is a real drug and it's going to get approved if we just do the confirmatory pivotal studies, or maybe it's even on the cusp of an approval. And so, that's what we expect, that pharma biotech are going to continue to be there. We think they definitely sharpen their pencils in environments where those valuations are more reasonable, where they don't feel they're significantly overpaying for those assets. But again, we still see outsized valuations in M&A if you've generated clinical data in important markets. So I think the strategics play a continued important role in the ecosystem that kind of interacts in different ways, regardless of the macro market environment.
Thanks, Chris. And as you're thinking about it, right, we've talked about valuations being high, valuations coming back down. A lot of this has to do with rates, right? And we've seen the recent rate cut. What is the implication for you in terms of what the actual rate change does for you, for your outlook, for your companies, how to plan for capital raises into the future, and then what is the implication more broadly on the IPO markets for next year potentially?
Yeah, I'll take that. So when you're raising a closed-ended venture fund, and especially if your LPs are big endowments and pension funds and foundations, that they're going to invest year over year in multiple strategies. And so they might change their allocation of private biotech or public biotech or tech versus biotech or other sectors. But for the most part, they're deploying capital year over year in those strategies. So I don't think interest rates affect significantly those allocations or the willingness to invest in closed-ended venture funds. I mentioned earlier, by definition, this is patient money. They want to generate higher returns even than you get on good fixed markets in high interest rate environments. But for the public markets, which I mentioned does drive the level of interest, the willingness to invest in early stage companies, the ability to exit those or have liquidity events to take those companies public, is impacted by how much money is flowing in to the public markets. And I think interest rate cuts is what we've been waiting for to kind of give a booster shot, if you will, to those inflows into biotech particularly, especially being a sector that has been oversold in recent years. We think that that's ripe for more money coming in to those sectors that have been depressed. And so I think, if anything, they might outperform some of these other sectors because of the drag that we've seen over the last few years.
Yeah, and I would add that we at Vita, we do see the IPO window opening, but the phenotype of company that can go public, that has shifted, from a few years ago, and from a few years ago, a platform company with maybe some preclinical data in the right space, a good story. Those companies were going public literally every second week, if not every week. There were something like 115, 120 IPOs in the calendar year. I think it was 2020 or 2021. Yeah. And so that was kind of the market, back then. Today's market is very different. Today's market is more around, clinical data, large markets, a validated team, i.e. a team that has had success in a previous innings, and really funding to, again, whether it's a phase 3 or registrational study, that's what's going public today. I would say that many of the aftermarket IPO sort of performances in the last 12, 18 months, they haven't been great. And so there has been a risk-off, mentality as it pertains to what targets are interesting, what indications are interesting, what stories are interesting.
Well, maybe pulling on that comment that you just made around the IPO performance aftermarket, what do you think has been the right recipe for the success stories this year?
So what I've observed is I think we really need three sort of ingredients to use the recipe analogy. The first is the right, I would say, clinical data for the right target. The second is an indication, which is a large, sizable indication, what we call a TAM, a large TAM, and we're really referring to peak sales of that market, and even within that market, the peak sales of the drug. That's the second ingredient, and the third ingredient is a team that resonates with public marketing investors, which generally means a team that's had some sort of track record of success, whether it's a successful exit, M&A, or successfully leading public companies. Those are the three ingredients that we've observed, and as we think of our private companies and what they need to show, such that they'd be good candidates for a successful public offering, so we can attract the right set of next investors, both biotech public market specialists and generalist investors. That's the formula, if you like, that we're using.
Yeah, so I would just add to that that's absolutely right in terms of the recipe for the cake. The icing's important because that's going to attract the level of interest, and that is the differentiation of that data set. We're seeing kind of the advent of a lot of crowded spaces, right? Obesity is an example, right? I&I. We're seeing a lot of fast followers. And so at the end of the day, you need to show that you're clearly differentiated. That might be good PK data to show you have an extended half-life of an antibody target, right? Could be enough, and we've seen that be one of the more successful trades over the last few years. But that differentiation is an important icing on the cake to be able to attract that level of interest.
And I guess then taking it back to the private markets, are there therapeutic areas that you're seeing today where there is real excitement, and then others that where its capital has really moved away in a significant fashion over the past few years?
Yeah, look, I'd say this is one of the more exciting times for early venture investors. And the reason is that we always have to think about, we invest because of the technology and the team, but we have to think about exit. And there's really only two ways to exit as a venture capital investor. There's technically a third way, a secondary sale, but that doesn't happen very often in biotech. So you either have to be able to take the company public to get a liquidity event, or you need to have the profile that's attractive enough to be acquired. And I mentioned earlier, you have to get clinical data for the most part to be acquired at a high valuation. And so as we think about that, we think about who are the natural acquirers of the companies we invest in, or what will attract the public market investors to invest in that in an IPO. And often that's linked to the idea that there's going to be a buyer out there to acquire the company at some point, right, to get an ultimate premium. And so we have to look at what is pharma and big biotech interested in. So, for example, if there aren't many natural acquirers in infectious disease, that's going to influence our capacity and interest in investing in infectious disease. So we saw, for a long time, cancer was dominating, right, the level of investment. Rare disease was the rage, right? We saw a little bit of I&I, but what we've seen over the last couple of years is a return to a more balanced view on therapeutic areas. So we're seeing, immune inflammatory disease kind of overtake cancer in terms of level of interest. We've seen CNS get revived, even neuropsych, psychiatry, in addition to general neurology or CNS and rare disease. We're seeing cardiometabolic really become almost a cottage industry of followers to improve upon the GLP-1s and their success. And so we're seeing ophthalmology targets getting taken out. So for venture investors, we're seeing that there are a lot of therapeutic areas that have natural acquirers, and that means that we can really look across a broader landscape of opportunities for investing early stage.
Yeah, I think Chris has summarized it well. I would take a step back and say, M&A liquidity events, they follow good clinical data, which follows innovation, and we've seen that over the last several years, not just in the spaces that Chris has outlined, but our radioligand therapies is another space where you've had pretty impressive data from Pluvicto, a Novartis therapy in prostate CA, and then a number of acquisitions, early stage acquisitions, in fact, as pharma places their bets and tries to get a vantage point in RLTs, which a modality, not necessarily a therapeutic area, and so there is this what's hot in the moment aspect of deal making, which is a confluence of clinical data, the changing guard of pharma R&D and where they're going to place their bets, and actually what's actually out there in the market, whether it's the public market by and large, and to some degree the private market. The great thing about this industry is that pharma, the force of the industry comes from innovation, and so pharma, will continue to acquire, groundbreaking innovations overlaid with great clinical data for big TAMs. That's just the business model, and so, I think, the prospects of biotech, even if the macro or the drug pricing, is a bit cloudy, even if we've gone through a tough patch over the last couple of years, is actually very bright because you have pharma M&A acquiring true innovation.
Yeah, and I'll just add one thing on what Arjun said. The TAM is important. How big are these markets? And that attracts a lot of followers, right? Where they think the pie is big enough where we can differentiate. And that's kind of what you saw with the schizophrenia drugs that were acquired, right? That there's room for new modalities in certain categories. We saw this in the CAR T space with BCMA and CD19 and cancer. A lot of fast followers there where we got overcrowded almost in CAR T and cancer, hematologic malignancies. You're seeing it with the GLP-1s, right? And a lot of companies trying to figure out how to carve out a niche in those spaces. And so, Summit, just their data, the number of companies that want to be formed around a dual, VEGF, PD-1 approach. So I think the market is very efficient in following good data sets where the TAMs are large enough to absorb, more than a couple drugs.
And that's a good point. And one of the things that we always talk to folks, and especially large pharma, is concerned with IRA, Inflation Reduction Act. And this notion of TAM always being kind of on the cusp of flirting with this little bit of a danger zone with IRA. I guess has that, as that crosses pharma's mind as they're thinking about M&A and the smaller guys, how does this change your investment thesis and how you approach, starting companies and going beyond?
Yeah, I'll start with that. So it's somewhat heresy to suggest that IRA is not going to have an impact. It's definitely going to have an impact. But for early venture investing, okay, we're dealing with very low valuations, and our goal is to try to get to that de-risking catalyst event that might bring a company from a 50 to 100 million, right, valuation to $500 million, billion plus, right? That is our goal. And if you were to see pricing significantly curtailed, and this is CMS, so it's one segment of the market, there's still a lot of money to be made as investors in early stage venture. So I think it impacts us less, but it's what I said earlier. We're watching what pharma's doing. How is pharma changing how they're going to be building their pipelines? What are they interested in, right? We're not seeing a big sea change yet, and may not, in, we're going to get out of small molecules completely from the big pharma companies. So I think we still want to invest in the things that are going to be attractive to the pharma companies. The other thing is, now that we have the first cycle and we saw the actual discounts of the top 10 drugs that were named, a lot of people don't fully appreciate that CMS is already negotiating significant discounts for every drug, right, to be able to play in that game. And it's usually the best price already. And so when we looked at where the current discounting already was pre-IRA, and then you add on the other layer of further discounting, that incremental discounting, okay, is not as significant, right, as what might have been thought. There were a couple drugs that kind of fell into more significant discounts, but it's basically taking a shorter haircut to an already, kind of big chop off of that, what we call wholesale acquisition cost. So I don't want to suggest IRA is not going to have a big impact, but there's still going to be interest in driving innovation, blockbuster drugs. I think the biggest impact is going to be in how you sequence the indications, right? It used to be, let's go after the rare disease first and then go after broader. It used to be, go after stage 4, metastatic, relapse refractory, and then go broader. You might see more clinical strategies trying to get bigger indications earlier as a result.
Yeah, Chris makes a really good point, which I'll follow on, and it's really, whilst on the small molecule side, at least we haven't seen any reduction in investments in small molecules. And in fact, some of the most successful IPOs in the last 12, 18 months have been small molecule companies and acquisitions. What we have seen is the capital formation around clinical development for small molecules, because the patent life has gone from 13 to 9 years. And so what we find is that we're sequencing multiple indications, running multiple expansion cohorts in the oncology setting. We're also sequencing monotherapy with combination therapies, various combination therapies, which means that we are really looking for the right partner earlier on, so we can be competitive in these very fast-moving spaces. So that's the one difference I've seen in the mid to late stage development when it comes to oncology. It's really we're really really competing with pharma on 4 or 5 studies for a target, as distinct to one, which was the case a couple of years ago.
So I think I would be remiss if we didn't spend a little bit of time talking about how the election might impact capital flow. How do you guys see that impacting both on a short-term and long-term basis? There's obviously a lot of different scenarios we could potentially see, but be curious to understand how you think through.
Do you want to take that first?
Yeah, sorry, what impacting?
The election.
The election, yeah, absolutely. So, yeah, that's for an Australian, walking into a discussion on U.S. elections is always interesting. So, again, I would take a step back and say, the life cycle or time horizon for value creation in this industry from when we invest, it's actually multiple election cycles. So if we find the right compound with the right from the right investigator with the right team and the right capital formation, that's really what that's what triggers an investment for us, or triggers subsequent investments for us. Election, there is no question, or there will be some trepidation or overhang when it comes to the public markets, when it even comes to deal activity, whether it's financings, whether it's potential pharma deals, because there is a question of just lack of clarity who wins the elections, certain commentary around the FTC as well, and whether the discourse of the FTC changes, which pertains more to larger pharma M&A and transactions. But from our perspective as early to mid-stage venture investors, we're still focused on the fundamentals of science, teams, products in large market indications.
Yeah, look, it's always hard to gauge this. In general, both candidates and parties have still continued to put a target on pharma and drug pricing, and that's not good for our industry broadly. However, if you look at the Biden administration, many in our industry would agree that it was an overreach with IRA. There's been a lot of rhetoric about march-in rights and basically just, doing away with patents if the need arises. And this concerns a lot of people. It's harder to tease out exactly what a Harris administration would look like, but if the assumption is that they're going to continue along the Biden track and look for more overreach, that would not be good. But really, this has more to do with our need to drive the legislative agenda in Congress and who is holding the reins in the House and Senate. And obviously, there's veto power from a president. But we're trying as an industry to try to influence and educate why you don't want to kill innovation, which is our future drugs, and why you really need to allow that kind of free market system to work in our country. The Biosecure Act did have this is the one that restricts use of certain Chinese vendors that had broad bipartisan support. And so that suggests that there might be a wave to bring back some of the CROs, some of the more management in the US. So we're all trying to figure out what this means over the next decade, regardless of who wins the presidential election. But I think we're going to be paying very close attention to the legislative agenda, and if we can stop any further overreach or even reverse some of the things that might have been codified in IRA.
Could you speak to how you're thinking about structuring rounds in this environment today? So how you're structuring in terms of the size, the amount of capital that companies should be raising, and then how you are legging into investments based on milestones or other factors?
I'll just speak to, it's what I said earlier, it's become a buyer's market. So for once, for a while, VCs can actually dictate more terms, more tranching, pushing back on outsized valuations. So that's a good thing for us to be able to manage those investments with tighter reins and to hit milestones before we put more money into a company. So all of that is very good. So I think structure in this environment has favored, because when investment is scarce, you have a little bit more influence of what those terms need to be. And so I think the other trend I'll let Arjun talk to is pushing more larger mega rounds into proven management teams. You can talk a little bit about that.
Yeah, absolutely. So, one of the things we have noticed is proven teams attracting. Mega round is defined as 100 million plus financing, even at the early stage. And what that allows the team, with a broad-based syndicate, and what that allows the team to do is generate value-inflecting data that means something to late-stage investors or crossover investors. And it depends on the target, depends on the indication. But generally, when we construct these rounds, we're generally looking to fund the companies to early clinical data that is de-risking, that allows us to validate what we believe could be a best-in-class TPP, target product profile. And so that's what we're looking to achieve with these 150 million plus rounds. The other point to note is, and you've heard this in the panel, is that there has been a renewed focus on larger markets, larger indications for larger markets. Unsurprisingly, that requires more capital to run the right study, and as a result, the round sizes have also increased.
I guess as you're sitting here today and you're looking at your portfolio companies, there's some that were kind of started in that boom era, right? And their valuations are a little still lofty. What's the advice to these companies that are still private, right, that have these lofty valuations still? How are they taking this notion of down rounds? How do you go about that? And how does that all kind of come together, right? It's kind of you got to swallow the pill, so to speak, and live for another day, I assume. But love to get your thoughts from a VC point of view.
So the way we think about it is, and Chris alluded to this, the maths is pretty fixed. There's a valuation at which you go public. There's a valuation at which you raise the prior round, whether it's a Series B, Series C. There are sort of modest expectations of step-ups in between. And so if you do the maths, you'll figure out what your valuation or your post-money valuation should be going into an IPO. Now, that's in today's market. In yesteryear's market, the frothiness of the market meant that many of these companies, John, as you alluded to, have frothy market valuations, and so there has to be some recalibration of those valuations, a down round, so you can meet the maths of today's markets. The discussions we have is that the most important thing for us is to make sure our companies continue to develop the science, prosecute the science into medical products, and attract world-class investors on the private and public side. So we encourage our teams to calibrate valuation through a market-driven process, not necessarily inside or around, but truly a market-driven process, so they can be right-sized for subsequent financings and ultimately a public offering. The most successful companies in this industry ultimately need to go public because to finance the mid to late stage product development ultimately requires public capital, by and large. And so for us, it's a function of just, being, for our companies to continue to be in the game as it relates to crossover investors and journalist investors.
Yeah, it's interesting. There are different objectives depending on the investment vehicle you have. So when a hedge fund has invested in a lot of private companies with the hopes that those companies would go public, and they're not able to go public, and so many hedge funds had a big book of private companies that they wanted to write down as quickly as possible to show less exposure and to be very conservative in those valuations. So we're part of that, larger enterprise. So we could not artificially hold our private companies high, which if you're a pure play venture fund, you might want to do that to not show, that you've got a bunch of zeros or potential zeros in your portfolio. So there's these competing tension in terms of public hedge funds that have private exposure versus pure play venture funds that have to figure out how to keep their mark as high as possible. So I think the market's pretty efficient. We have outside auditors go in and saying, are you going to be realistic? The last thing an LP will tolerate is you having an unrealistic mark to suggest that they're getting better returns when that company should be valued less. The other thing is that in the public comps, you can't come out and say, all right, we have a preclinical asset going after this target in this indication, and then you look at the public comps and they're all trading at 200 million, and you're trying to keep a higher value. So there's a lot of good checks and balances there to keep investors honest in terms of where they place that mark.
Well, I wanted to give each of you maybe an opportunity to provide any closing comments in the last 2 minutes here.
From our perspective, this industry is inherently cyclical, but there has been no better time from a scientific innovation perspective. In the last 12 months, we've seen groundbreaking data with immune reset in immunology. We've seen, the Pluvicto data sets in prostate. So that's what keeps us excited. Many of these data sets come from biotech companies. Ultimately, those data sets are scooped up by pharma companies. So whilst biotech does follow, a boom-bust cycle, a macro cycle, the fundamental, need for what we do remains a constant and will remain a constant.
Yeah, I'd say over the last few years, there's been a lot of uncertainty along a lot of parameters. So we're starting to see the overhang of some of those clear up that uncertainty, and this goes to interest rates obviously being one, IRA, what is that going to look like, FTC issues, FDA regulatory uncertainty and new leadership there. And so a lot of these we've kind of worked through. We have the election that will hopefully understand how that nets out in another couple months. And so I think that is all good for looking ahead to 2025, where we should be able to have a lot of that uncertainty removed from biotech markets, and we should get to a healthy, steady state environment where companies that deserve to go IPO will be able to go IPO, companies that deserve to get funded in early stage will get funded. So I'm feeling optimistic, short of World War III breaking out that could bring the markets down. I think we've had our fair share of downside in biotech, and I'm feeling pretty confident that moving forward we should be in a good spot.
Well, thank you both. It's been a great discussion, and thank you all for spending the time.